Hello and welcome to topic 4. This is about statement of changes in equity. This is a really small topic. So our learning objectives for this topic is to explain the concepts of underlying statement of changes in equity, identifying the components of equity. We will be discussing the prior period adjustment and the significant differences when it comes to statement of changes in equity and the retained earnings. Now, why would your shareholders' equity change? The reason for this change can be any of these items. Okay, it could be the issuance or the repurchases of share that will either increase or decrease the number of shares as well as the share capital, the increase or decrease in your contributed surplus. Now, this concept is covered in way more detail in Intermediate Accounting 2, which is your Accounting 350. So we'll discuss it there. The retrospective adjustments of the retained earnings. Now, retained earnings could change. So your beginning retained earnings is the ending from the prior period. But if we do have any changes because of the change in the accounting policy for retrospective application, or if there are any prior period errors that have to be adjusted, then we will have to restate your beginning retained earnings before we move on. The comprehensive income, that is really your net income that is added to your retained earnings, and OCI, which was your other comprehensive income, is then moving to accumulated OCI account. And as we had said earlier, your OCI concept only exists under ASPE. It only exists under IFRS and misses under ASPE. ASPE does not recognize OCI concept. And finally, if the company is paying out dividend, then that will reduce your retained earnings. So any or all of these transactions will change your shareholders' equity. So looking at our prior period adjustment. So your prior period adjustment is made to the beginning retained earnings, and this has to be net of tax. Now, if you guys think of the flow of information, your net income or loss, which is after your income taxes, is what actually flows through your retained earnings. So if we do have to restate our beginning retained earnings in the period, then the effect to that retained earnings has to be net of tax, meaning after tax. So this will be for the retrospective applications that is resulting from a change in the accounting policy. So let's say if the company changed from first in, first out inventory to average cost, and the resulting adjustment is because of that change. So we will have to capture the retrospective effect and restate our beginning retained earnings net of tax. The same idea applies with any prior period errors that we have come across. So this is what our statement of retained earnings under ASPE looks like, and sometimes it can be combined with income statement. So here we have our statement of retained earnings. So for your year ended December 31st, 2020, so that is your beginning balance on January the 1st was reported at 1,050,000. But before we make any changes for the current year, we are updating our beginning retained earnings for the correction of understatement of net income in prior period, which is coming from inventory error. And that is net of tax of $12,000. Okay, so the net of tax amount is $50,000 for prior period adjustment. That gives us our adjusted January 1st beginning retained earnings. Then we bring in our net income, and finally we deduct our dividend. Now here we have shown the effect of dividend for the cash dividend as well as stock dividend, and that gives you your ending retained earnings on December 31st. So this is the more easier structure that is followed under ASPE, that is statement of retained earnings, but the statement of changes in equity. So this is the format that we have to follow under IFRS. Now this one looks quite complex. It really depends on the business and the transactions that they have gone through that affected their equity accounts in that particular period. Okay, so some of these columns could be there, some of that information could be there, not all. So it really depends on what information the company has gone through in that particular year. But we will, under the IFRS requirement for the SCI or the statement of SCIE, SCI is Statement of Comprehensive Income. SCIE, which is your Statement of Changes in Equity, we are required to capture changes in any equity account, be it the number of shares or the total dollar value. So the shares, retained earnings, contributed capital, okay, non-controlling interest, which actually comes from the process of consolidation. So all of that account, all of those changes are accounted for and reflected in your changes in equity statement. And that is all we had for this particular topic. Thank you for listening.